Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today we have our Frac Spread Count show where we're going to look at the completion activity that's happening in the U.S. Then we want to look at, where's demand right now as we shift towards the past the summer driving season into the fall and the shoulder season, and how is inflation going to continue to play out, looking at retail sales as well as some other key impact or key drivers to this as we head into the end of the year. So without further delay, getting right into the completion data, you can see that we went from 252 to 264. Now, when we last spoke in the insights, so I obviously wasn't here last week, but I wrote in the insights that we expected to see some increases in frac spread activity, and here's where you can see that increase. So, I was here. I did do the video. That's right. I landed and then came straight here. So what we talked about, not only on the insights, but also on the show, you can see these increases. So we expected to see it in the Permian. We expected to see it in Western Gulf, and that's exactly where we saw a lot of that expansion, with the lion's share of it being in the Permian, going from 252 to 264. Another increase in the Western Gulf, and a small amount in the Appalachia markets. So that's something that it's going to be really important, because as we start to progress further, we didn't do the EIA show today. Don't have Bloomberg at the moment. Still working on that. Your support would be helpful to afford that. But so please like, share, subscribe. But some of the key pieces here when we start looking forward are some of these expansions that are not only just driven based on price, but more driven based on seasonality as well. So European purchasing slows down in the beginning of the month. We should see that pick back up, but we have seen some slowdown in exports into Asia. There was some pre-buying when you look at October, November. We just don't see some additional buying, which again will keep, even though we might get some additional builds in pad 3 on the crude front, it's still going to be very supportive on a pricing front. So we do see this continuing. Now, it looks like we did find a floor on the rig side, which again will help support that the spread activity and completion activity, not only as we go through September, but also into October. So here, when we look at the oil and gas, oil was up by 2, gas was up by 8. The key one that we always keep talking about is horizontal. Horizontal was up by 5, directional up by 1, vertical up by 3. So typically what you see is when you look at the movements, vertical will run ahead, then you'll have the horizontal come behind it, and then you'll have the completion crews running as well on the backside. When we look at Texas had the biggest increase of rigs. When you look at 7, New Mexico had a decline of 2. Now, this is interesting because when you look at the pivots, the liquids market is has a lot of weight on it right now. The pivot has been more into the oil market, so the pivot and move away from the Delaware into more of the Midland, which again is, the Delaware goes over into New Mexico, where the Midland is all in Texas. I think that makes a bit more sense when you start looking at some of the plays, some of the pivots. You have E&Ps that are trying to manage what their corporate profile looks like. So again, these are things that we think make more sense and are going to continue to be the case. Obviously, rigs didn't go up as much as completion crews and spreads, but that's something that we think the spreads really kind of lead this in the near term, just especially based on a seasonal standpoint. Now, this is one of our favorite charts from the EIA show. Obviously, we still have the data, so we can put this together. And here, when you look at the finished motor gasoline, the jet fuel distillate resid, you can see how we are holding right in line with where we were in 2022. There was a sizable drop in gasoline from 9.3 to 8.3. As we said last week, 9.3 was too high. Or I should say, in the insights and something that we commented in the FSC show. So again, that 9.3, way too high. 8.3 is probably slightly lower than it should be. It's probably closer to about 8.5, 8.6, but we will trend down to that 8.3 over the coming weeks, not only just based on, pricing, but also because the seasonal demand slowdown. And on the distillate side, things have slowed down as well. Again, they've kind of flatlined on a demand cycle, but now you have that shift up in pricing, which is going to put more weight on the consumer and is going to slow down demand further. So one of the things that we talked about, realistically, Saudi, Russia has achieved their goal of increasing prices, but at what cost? When you look at the demand side of the equation, you have diesel prices that are up again, gasoline prices that are up again. I thought this was a really good chart, putting into context where we are on a month-over-month basis with this increasing move in gasoline. We talked about it on the Econ show yesterday. How that has been the biggest driver behind, or I should say energy costs behind the increase in CPI. But then when you look at PPI, or the producer price index, that has shifted up again because the cost of operations is going higher. And then when you look at the year-over-year comp, going back to 2022, you have you have easier comps. So it just means that month-over-month increase is just ratcheting up while you're also getting that year-over-year accelerating again, and that's putting that pressure there. All the while, wages, as we talked about yesterday, wages have started to roll over as we're getting that reacceleration in inflation and those inflationary pressures. Gasoline is going to hurt. The consumer sees that directly. So again, vacations are over. Why are you going to go drive with especially given these prices? And then when you look at diesel, that's the one that compounds and is going to be the bigger issue as we go into the end of the year. And I think this does a really good job of kind of showing where those issues are. So PPI final demand services, monthly change, you can see it's pretty muted in terms of services, what we've been talking about, kind of the steady state up. But the thing that we talked about in July was that on the PPI final demand for goods, that was going to see a big pivot up. And here you can see that big increase where the goods sector, a large chunk of PPI inflation increase in August with 2% month-on-month gain compared to services, which was 0.2% gain. And you'll be surprised to know that 2% month-on-month gain on the goods front is energy cost. And what we're now seeing now, so Russia just came out and announced that there's a good chance that they are going to stop or pause exports of distillate and of refined products because they're having a shortage. A friend of the show and someone asked a great question of what is going to happen because he was seeing, he's a Russian national, he's in the country, and he's like, we're seeing, shortages of refined products. How is Russia going to fix this? And one of the things that we had talked about was they could likely put up a gate or limit the exports, whether that be an outright ban, whether that's putting up export duties or taxes. But because you had such a healthy market internationally for distillate, it's good. Even a 40% increase in export taxes, you're still going to be competitive. So here's where we start to see some of the pivots where they could put an outright ban. Again, it takes a lot of diesel to drive a war effort. It takes a lot of these different things, and but losing those Russian exports, even for a short period of time, is just going to drive up the prices of these refined products, not only support refining activity, but also drive up the price for other consumers around the world. Now, when we look at consumer goods portion of PPI, it has started to reaccelerate. That is not surprising when you look at the things that we've been talking about. The 3-month annualized gain has shot back up. But again, when you look at that yellow drop, what we've been saying is it was barely even a move on the notional number, which is why we expected to see that increase and that bounce back. Now, I thought this was a really good chart, kind of putting into perspective the absolute CPI growth and that march higher. It's up 22% from that low point in 2022. And if you're sitting there kind of doing the math in your head or thinking about your calculations on, the impacts you've seen from your own personal experiences, I'm pretty sure you're going to come pretty close to that 20% number. And that's where I think the market sometimes misses the pain in the CPI side because everyone looks at the year over year, but not that March higher that we've seen. And now as we're starting to see it, and you can see it at the very end of this blue line, that pivot back up. Now, unfortunately, we're going to be in this reaccelerating point. So then when we start looking at retail sales, after adjusting for inflation, U.S. retail sales fell 2% over the last year, the 10th consecutive year-over-year decline, and the longest down streak since 2009. Nominal retail sales increased 1.6% versus a historical average of 4.7%. So again, you're still seeing positive growth, but it's important to appreciate where is it against inflation? How is it compared year over year? Obviously, last year was a bit stronger. We're seeing that year-over-year decline, which is something that we do see continuing. Now, this I think puts it into a little bit better view in a shorter time frame, where you can kind of see on an adjusted basis things are flat. On a core basis, things are also fairly flat. Obviously, this also puts into perspective how big that nominal increase has been versus the real after the adjustment for inflation. But what is driving that? And that's where we think the U.S. retail sales puts in that breakdown, puts it into great clarity. People are spending more on gasoline. And so again, that huge hit, that shocking number is what we see as kind of shaking people, saying, well, do I really need to drive here? Maybe I can not drive as much. And you're starting to see some of that walk back. Core sales, you can see here, as continue to decelerate. Now, one of the things that we said about July was that was likely just kind of that blow off top, where you have July is peak vacation season, but the trend is still intact. Our view is that you were going to get that step down, and you can see the step down continues. And at some point in the next month or two, we do see that flipping negative and seeing some of that accelerating pressure. Now, one of the fun things to kind of leave you with is the bond bull market versus bear market. For those that have been following us, we called the quote unquote end of the bond bull market back in February of 2021. When we wrote that article saying that it really ended in 2020, and now you're seeing kind of the ramifications. Now, bull markets, especially ones that have been going on as long in the bond market since the 1970s, obviously you've had bull and bear markets in shorter time frames, but if you look at the longer term, this is the first real kind of breakdown of where things are, and we don't see that changing. And some of that is going to be because the central banks are going to be stuck trying to keep some of these prices, ratcheting them down and kind of cordoning them off. And the UN Food Price Index is one of those where we see it actually pivoting back up. You can see August, it's still, it's right here. But then when you look at the futures market, you look at where the market is right now, you actually see that picking back up a bit. And not that it's going to surge back to the highs, but the UN Food Price Index and that weight is going to continue to be an overhang, and that's something that we're going to talk about when we look at some of the most recent Chinese data. Yes, it was better than expected, but it was mostly driven based on state-owned enterprises, not private, and that's something that we talked about over the last couple of weeks, is that the data was really being supported by state-owned enterprises. But in order to get a more fruitful or longer term shift in economic prowess and economic growth, they were going to have to rely more on the private sector. And so far that is not materializing, which is why we do think these increases are short-lived as these pressures continue to mount. So that's what we have for you today. Again, we can't stress enough, please like, share, subscribe. If you're interested in advertising on the shows, we'd love to hear from you, and we hope you enjoy you enjoy your weekend and have a great next week. I will talk to you next time. I will be traveling. I'll be in Calgary. So I'm not going to be able to do any of the shows next week, but I will have our insights coming out on time as usual. And obviously, if you have any questions, please let us know. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.